Hedge fund manager Ray Dalio of Bridgewater Associates receiving the Money Management Lifetime Achievement Award from Institutional Investor last night. And our own CNBC hedge fund producer Manita Huja caught up with him. Here's what he had to say when asked if all of the Fed's quantitative easing has been artificially inflating the markets.
I think that what has been artificial is that there's been a lot of printing of money, which has driven short-term interest rates down to make cash a terrible investment and to make bonds a terrible investment. Both the printing of money and also the seeking of safe returns have driven money into cash. And so with a negative real return of about 2% in cash and 0.5% in bonds, that's a bad investment. As a result, there's a reaching for return, and that's driven other assets up. And there's a beginning of a leveraging process. And that is good for assets over the near term. So I think that assets will continue to appreciate, but there'll also be a tightening ahead.
You know, Ray's been right. We had him on from Davos, and I think we had him on again last fall, and he predicted a little bit of where we are today. Said there'd be a turnover. But we haven't seen the full turnover from bonds into equity yet. We've just seen
the grand rotation.
The grand rotation.
Yes.
The grand rotation.
What he said there
almost
was,
at 2% on the 10-year.
Right.
What he said there was pretty boilerplate, right?
Yeah, he wasn't giving away too
sort of
much.
affirmed what, I mean, it wasn't much different than what Tepper said. Were you here for Tepper?
Of course I was.
Okay. Yeah, you were. All right.
It was a good interview.
Yeah.